Hello, everyone. My name is Peter Walker. I'm the head of insights here at Carta, and I'm so happy that you're spending an hour with us today to go over what happened in venture capital in Q1 of 2024. We've got a ton of data to get into, as well as a wonderful guest in Nicole DeTommaso that I'm going to bring up very shortly. But before we get to Nicole, I wanted to take a moment to walk through what Carta knows about what happened in Q1. So I'm going to go ahead and share my screen here. To be clear, all of the data that we're going to present today is live in the Q1 2024 State of Private Markets report. You can go ahead and view that report right now live on Carta as well. So let's get into things. I'll preface this conversation by saying I don't have a lot of fantastic news to give you, unfortunately. To be honest, I was slightly disappointed in the numbers that came in for Q1. But we're going to try to find some silver linings and then prognosticate a little bit about what's going to happen in the rest of the year. Here's a word from our lawyers at the very top. And of course, if you're on this call and you're not familiar with Carta and what we do, we are an equity management platform, and we are increasingly the home of pre-seed startups. So whatever you may have heard about Carta, it is completely free until you raise your first $1 million. You can jump on our Carta launch platform right now. The report I just mentioned live on site has more data than just this and also breaks things out by industry, which we won't get into too much today. But let's get into the numbers. I think tepid is the right word here. Q1 was basically flat from Q4, which was unfortunately basically flat from Q3 of last year in terms of total dollars invested into Carta companies. There are about 43,000 startups these days that use Carta in the US. And you can see this was a major shift from the boom times of 2021. We are no longer in those sugar high times, and it's been kind of muddling along here at the bottom for the last 3 or 4 quarters. One of the key indicators that we track in terms of the health of the venture ecosystem is the percentage of rounds that are down rounds. So this is quarterly, the percentage of all rounds on Carta that were down rounds, i.e. the valuation of the new round comes in less than the valuation of the prior round. And it actually peaked in Q1 of 2024. Nearly 1 in 4 rounds completed on Carta last quarter was a down round. Good and bad things here. So the bad, obviously, down rounds are no fun for anyone. It's a difficult moment for founders, investors, especially employees who maybe don't get as much information as those other 2 groups. But in the silver lining, it does mean that founders and investors are coming to terms with the fact that the valuations given out in 2020 and 2021 were just too high. And there is a quality business in there somewhere. It just needs to be valued at a lower valuation before things can move forward. So what have venture capitalists been spending time on? A lot of time and attention is going to bridge rounds. That is, if you raise a seed round and then you need a little bit more capital before you get to your Series A, that would be a bridge or an extension round. 42% of all the seed rounds on Carta last quarter were actually seed extensions or seed bridges, not new primary rounds. And the time between these financings is also increasing. So if you take just between primary seed and primary Series A, the median time that it takes a company to get from seed to Series A is now over 2 years, the median time. So there's a lot of companies that are taking far longer than that. The median time from A to B is approaching 2.5 years. So if you had gotten advice from venture capitalists or other people in the ecosystem before that you're going to raise around 18 to 24 months after your last round, that advice is out of date. It's going to be more like 30 or even 36 months sometimes. When we take a look at valuations and rounds completed juxtaposed against one another, I think this paints a really interesting picture about what's going on, especially at the early stages. So the black line in this chart is the percentage change from Q1 2022 in terms of the pre-money valuation of companies in each stage. The orange line is just the total number of rounds completed versus Q1 22 as a percentage. So you can see at the later stages, everything was down. Total rounds are down, valuations are down. They're kind of falling in tandem. But at the early stages, valuations have held up really pretty well, basically flat for seed stage companies. But the volume, the number of rounds being completed is way down. So this points to a quality difference at the early stage, as well as a lot of differences in the kinds of investors that are investing there. But it's a very different world if you're raising a seed round than if you're raising Series C, D, or E. So what are these data? You can walk away with some tangible evidence from this call today. We've got the black line is the pre-money valuation of seed stage rounds on Carta. It peaked at 14 million, 14 and a half. And right now it's just under 13 million. So still pretty robust valuations, but fewer companies are getting to raise those rounds. Again, just follow the black line here. This is for Series A. The peak of Series A valuations on Carta was about 50 million. Right now they're at about 41, 42 million for a primary Series A round in the US. That again is pretty robust, pretty healthy. You know, if you were raising a round for 41 million in Q1 of 2020, that would have been a pretty impressive Series A. So valuations are pretty robust, but fewer companies getting those rounds. Entrepreneurs, you will sell probably around 20% of your business in a seed round and a Series A round. So it's a little higher in seed, a little lower in, a little higher in Series A, a little lower in seed, but that rule of thumb still holds true. And then you've got B, C, and D rounds following on. And for those of you who are thinking about perhaps this is a time where my business might get acquired, just know that yes, acquisitions are still happening. We had about 150 companies acquired off of Carta last quarter, but it hasn't been a boom. There's no real signs, at least on our end, that there's going to be a major wave of M&A coming. It looks like it's just going to be steady across the board for the next couple quarters. For the employees on the call, if you joined, a little bit of a note on your equity and how other startup employees are treating things at the moment. It looks as though the exercise rate, that is the percentage of equity that is exercised, those options before they expire, actually bumped a little bit up in Q1 2024. It wasn't a major change, but if you look at that black line, it's the first time it rose in about 10 quarters. So at least that's somewhat of a silver lining. And when it comes to the termination of those equity grants, it's still the case that the vast majority of employees only have 90 days to exercise their equity after they leave a company, whether by choice or through layoff. Only 20% of option grants on Carta have longer than that 90-day period. So this is a personal hobby horse. I hope to see that percentage increase over time. And when we get to the final point around employees, which is, of course, layoffs, you can see that that black line is the number of employees that are leaving by choice every month. And the orange line is the number of employees that got laid off that month from across all those 43,000 startups on Carta. Good to see that layoff line decline. It's nowhere near the peak, which happened in January of 2023, but nor is it back to normal levels. So I do think that there's perhaps still more layoffs, unfortunately, although on a much reduced basis, moving forward throughout 2024. And with that, I'm going to welcome Nicole up onto the stage here. Give me a moment. I know that was a ton of data and information, and thank you for those who threw in comments. I'll look through those as we go along. But Nicole, why don't you come on up and join me? Good morning. How are you doing?
Good morning. Thank you for having me.
Absolutely. Why don't you give us a little bit of background on Harlem Capital and your role there?
Yeah, absolutely. Absolutely. So I'm Nicole. I'm a principal at Harlem Capital. I've been with the firm now for about 3.5 years. I sit on the investment side. So what is Harlem Capital? We're a diversity-focused fund investing in women and people of color, typically at the seed stage. We are on our fund 2 right now, which is 134 million. We write checks of about 1 to 3 million, leading most rounds. And in terms of industries, we are agnostic, but I'd say that we have an affinity for B2B software, enterprise and vertical software, fintech and e-commerce enablement. That's where we have a concentration in our portfolio. And we're a team of 7. So we have 5 investors, 1 on the platform side and 1 EA who helps out the team.
Any focus in terms of geography or investing in companies across the board?
US based, but entirely across the US. No favoritism in terms of cities across the US.
Gotcha. Yes, no favoritism here either from the Carta's end. Okay, so those were I don't know what the exact right word is, dispiriting, not amazing numbers. Just broad-based question to kick things off. What was your perspective on Q1, or how did it feel for those inside the doors at Harlem Capital?
Yeah, I think, internally and in speaking with other investors, it was a very slow quarter. I think a lot of people thought that off the backs of Q4, we would go into Q1 and there would be a lot of deal flow, people would be raising. And ultimately, in speaking with others, a lot of VCs, early stage VCs at least, hadn't done any deals. If they had done some, it was maybe one to two, right? So it was a very, very slow quarter. I think also what you're seeing is that the bar is just getting higher and higher for investors to invest in terms of metrics and traction needed. And it's ultimately an investor-friendly market, right? And so there's a lot of choice. So high level, I'd say it's slow.